The term 10-bagger was popularized by Peter Lynch, who used it to describe stocks that had multiplied in value by 10 times. Over time, discussions on 10-bagger gave way to 100-baggers as the world's equity markets continued their one-directional upward trend. India too has had its fair share of 100-baggers, with dozens of companies reaching that milestone over the years. Infosys, Titan, HDFC Bank, Asian Paints, the usual suspects are all there. But if we think a little broadly, the BSE Sensex, which started at a base of 100 in the year 1979, first became a 100-bagger when it touched 10,000 points in February of 2006. And so in this video, we shall look to identify some of the strategies and characteristics one needs to look out for in order to increase one's wealth by 100 times in the stock market. To this effect, we shall study the approaches discussed in a couple of books. The first one is a book by Thomas Phelps, which goes by a rather surprising title of 100 to 1, although the material and essence of the book is on converting 1 to 100. The second book we read as a part of our research was 100 Baggers by Christopher Mayers. We shall use the best of what these two books have to offer and aim to lay a blueprint on how each of us can identify the future 100 baggers. Let's begin. Let's start with some simple math. So we want 1 to become 100 in a few years. As a formula, this can be expressed as 1 plus the percentage rate of return raised to the power by the number of years. Now, an investor can use this formula in many ways. For instance, you might want to know the returns one should be targeting over the next 30 years to convert a lakh of rupees to a crore. Alternatively, you can use the same formula to figure out how many years a 12% annual return will take to become a 100-bagger. So that's the starting point, and one can build a number of combinations on top of this. For example, if you want to 100x your money in a mere 11 and a half years, then you need to identify an investment that can grow by 50% each year throughout this period. But if your returns estimates are more conservative, say 15%, then growing your money to 100 times will take a much longer 33 years. Now, the reason why I started with something that you'd have learned in your middle school mathematics class is to establish the first of the two essential factors for a 100-bagger, which is the company needs to be a growing one. It should be a company that is growing its revenue, growing its earnings, growing its margin, maybe growing its market share, and most definitely a company that is growing its earnings per share. The reason why this last part is important is because stock prices mimic the earnings per share over the long run. So if a company's EPS were to go higher, then almost always the share price of that company goes up on the long term. But merely growing the EPS is not enough, and that's where the second 100-bagger engine comes into the effect, which is a growing price-earning multiple. You see, a price-earning multiple or P ratio is not just a factor of how expensive a stock is. In fact, if one studies a stock or sector over a period of time, we also get to understand how valuable that company or sector is to the investors. So let's put the two factors together and understand this with an example. Let's take a company from the FMCG sector. Okay, let's go with Hindustan Unilever Limited. Now, we all know what HUL does, what its products are, the share price, its competitors, its distribution strength, etc. From a growth perspective, HUL has grown its annual sales by almost 9% over these last 15 years. Its net profits has risen by 11.8%, while its earnings per share has had annual increments of 11%. So a lot of these numbers are bunched up together. But when we track the growth in share prices, it gives a very different number. Because HUL's share price has grown at a CAGR of 17% over these last 15 years. So the real question is, where is this delta, this additional 6% coming from? The answer to that can be discovered when we examine the price-earning ratio of the company. You see, HUL's P ratio for a long time used to operate between the 25 to 35 band. But from 2012 onwards, the perception of this business in the eyes of the investor, or might I say the company's valuability or importance, had changed dramatically in a positive direction. As a consequence, the company's PE multiple jumped from the 25 to 35 range to a more expensive 45 to 55 band. And since 2018, there has been another re-rating of HUL's P ratio, and the stock now operates at a 65, 70, even 75x multiple to the earnings per share of the company. Now, structural jumps in P ratio might happen due to a number of factors. The most cited reason is the growth in the earnings potential of the company, which is normally the case with fast-growing or new age companies. But other than earnings, a P ratio re-rating can happen due to a few factors, like the improvement in profit margins, any loss of a competitor, or if investors are not finding viable investment opportunities in other sectors. And of course, there is the safety factor, and it is widely assumed that the demand for FMCG products remains stable even during a downturn. But other than these, one additional reason for a P ratios re-rating that I would like to discuss here is when a company migrates to a more valuable business. In that context, let's examine the P ratio of Reliance Industries Limited. Now, as this image shows, Reliance Industries operated in a price earning multiple of 12 to 17 for many years. But then in September of 2016, Reliance aggressively entered the telecommunication space with Jio, which then invoked a re-rating of the company's P multiple. Of course, it should come as no surprise that investors looked at Bharti Airtel's P ratio, which operated between 25 and 40 at most times, which then allowed Reliance Industries as a whole to receive a higher P multiple. So let's recap what we have learned so far. Firstly, earnings growth is important, and if a company is not growing, then there is little chance of the stock going up. And secondly, look out for companies and sectors whose P multiple is likely to get re-rated upwards. A combination of these two effects is probably the surest way for anyone to bag a 100-bagger. In their respective books, Thomas Phelps and Christopher Mayer have listed some of the key characteristics and situations that complement the creation of a 100-bagger. The first such consideration revolves around the ideal company size, and in that context, it's easier for smaller companies to become 100-baggers as compared to the larger ones. And this makes sense, doesn't it? I mean, a company with a 2% market share should find it a lot easier to double, triple its market share as compared to a company which is sitting at 30%. A lot of this has to do with the company's low base, and from a market capitalization standpoint, this would mean focusing more on companies which are currently valued at less than 5,000 crores, maybe even less than 3,000 crores. In other words, and if you remember the video that we had done on Rakesh Jhunjhunwala's investment in Titan, we are trying to catch companies like Titan in that 2001-2002 period when it was valued at just 200 crores, which is less than half of the profits that Titan makes today in a single quarter. Of course, this is easier said than done, but when it comes to the probability of 100x success, there is no denying that the odds are there with the smaller sized companies. Now, another point that Christopher Mayer raised is that while 100-bagger stocks seem to not favor any particular industry, he does advise investors to stick with the more established companies in stable industries. We think the reason for suggesting this is longevity, in the sense that if one has to achieve a 100x return over, say, a 30-year period, it is also important for the company to survive for 30 years, which is where the stability part seems to be coming in. Now, one of the most important support structures for longevity for any company or sector is the existence of long growth runways. You see, a longer runway means more avenues to grow and expand, which then translates to a substantial improvement in the company's earnings per growth. And that's probably what Reliance Industries is doing today with the Jio initiative, which along with mobile telephony also opens up a number of growth avenues like broadband, fiber, satellite telephony, OTT platforms, digitization of MSMEs, JioMart, a 4G smartphone device, 5G, and similar tech-enabled initiatives which are expected to last for many more decades. Now, a thorough understanding of a company or an industry is no easy task. It requires a lot of research, and so investors often prefer a single metric that can help them filter companies. And that metric is the company's return on equity. So what is return on equity? Beyond the formula, a high and increasing ROE means that the company is reinvesting its earnings wisely into the company, which can, like a flywheel, further increase profits and shareholder returns. Point blank, a company needs a consistently high return on equity to compound its capital efficiently, which will then pave the way for its stock to become a 100-bagger. Another common characteristic among companies that generate a high return on equity is the existence of a sustainable competitive advantage. This is often referred to as an economic moat, and we did a video to that effect on the ET Money YouTube channel where we discussed the different types of moats along with some real life examples. So very quickly, there are intangible asset moats like a company's brand, its patents and intellectual property. There are switching moats, which explains why people think twice before changing their bank savings account. Then there is the ever popular low cost provider moat, the toll moat, the network effects moat, the cultural moat, and of course the ever expanding and controversial data moat. In today's day and age, companies that aim to grow their earnings not only need to have a moat, but must endeavor to continually increase the width of that moat over time. Next up is the gross profit margin, and again, while the formula is one way of explaining it, what the gross profit margin really indicates is the additional value that the product offers to a customer in excess of the cost of making that product. And perhaps the best example of that has to be Apple, which continually delivers a gross profit margin of over 35%. And finally, owner-operator companies have the better odds of reaching a 100-bagger status as compared to agent-manager companies. To explain this quickly, owner-operator companies are those businesses that are managed and run by their founders or the largest shareholders. Companies like Reliance Industries, Wipro, Dr. Reddy's, HCL, Dabur, and the many companies within the Tata Group are all examples of owner-operator companies. More so, the numbers support the fact that companies whose owners have their skin in the game, make better capital allocation decisions, are very disciplined about acquisitions, use leverage selectively, they buy back a lot of stock, are focused on cash flows over reported profits, which all results in better share price performance. In fact, a 2012 study conducted by Joel Schulman and Eric Noyes showed that companies managed by the world's billionaires outpaced the index by 7% annually over long periods of time. And it's not only in the United States that we get to see this. Even in the case of Indian companies, profits generated by promoter-led companies have often outperformed the professional manager-led one. So if you're putting your money in the game, then it's probably better to do that on an owner-operated company who also has his skin in the game. Per Phelps and Meyer, your probability on reaching that 100-bagger goal is not only higher, but you're also likely to reach there faster. The research conducted by Christopher Mayer concluded that it takes a 100-bagger company an average of 26 years to become one, which effectively means even if you start investing early, you would be in your 40s or 50s when you see your first 100-bagger. This makes patience a key factor in your success, and it's very likely that you, me, and every investor will be tested along the way. Take Apple for instance. We know it today as the world's largest company by market capitalization, but Apple's ride has been a roller coaster all along, with the stock going through 4 different drops of 40% each in the last 20 years. Netflix is an even more intense example, with the company losing 25% of its value on a single day, not once as we saw in January of this year, but 4 times in the past. To put it differently, when it comes to stocks, he who buys right must also learn to stand still in order to run fast. And from that perspective, what an investor needs is a coffee can portfolio. If you're hearing this word coffee can portfolio or coffee can investing for the first time, all it means is a set of high quality stocks that you would buy once and will not touch them for decades. It's called coffee can because before the banking system was established in the US, people used to put all their valuables in a coffee can and hide it someplace safe. Net-net, the success of your 100-bagger strategy will depend a lot on what stocks you put inside that coffee can, and of course, how patiently you can stash away your investments and be prepared to not look at it for years. Remember, to make money in stocks, you must have the vision to see them, the courage to buy them, and the patience to hold them. And of these three, patience happens to be the rarest of the traits. Most investors don't try to hit 100 baggers. They instead hope to hit a double or a triple. Our objective today was to expand the range of what's possible and to present the concept of the 100 bagger as an inspiration to investors. I'm not sure where I read this, but there was a quote that said something like, "You only have to be right once to make it big." And I think getting a single 100 bagger can make a remarkable difference to anyone's financial condition. As next steps, I'll recommend that you keep a note of the various indicators that we explained today and then try out different combinations of market cap, return on equity, gross profit margin, etc. in a standard stock screener. Once you have a list of companies, then do the hard work of understanding it, scope out the competition, the industry, the risk factors, growth runways, etc. to see if it fits within the 100 bagger framework. And while it's true that all of this is a lot of hard work, do remember what I just said. You need to get it right just once, and the future rewards will far exceed the efforts that you put in today. And with this, we come to the end of this video. If you learned something new, then do tap on to that like button, share this video, subscribe to our channel, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.